The S&P 500 and NASDAQ crossed above all-time highs again. How many times has it been? Because I've lost track. We're going to examine that, plus underlying sector ETF trends, single country ETFs, and the number one performing ETF during the first half of 2021. It's not linked to cryptocurrencies, and it uses no leverage. I think you're going to be surprised by this one, so stick around. I'm DeLegge with ETF Guide TV. A warm welcome to all. If you're here for the first time, be sure to hit that subscribe button. Don't forget to hit the like button if you've been enjoying ETF Guide TV and the content that we produce here. By way of reminder, this week's ETF battles will feature a covered call ETF matchup. This is viewer requested, and many of you have been waiting for this particular showdown. This is going to be a quadruple header, so don't miss it. It's coming up this week on ETF Battles. Also, check out the viewer resources section below in the description area of this video. I offer 4 online classes. I offer free ebooks. I also have a portfolio grading service called the Portfolio Report Card. And I built all of this to help you towards your financial goals, with the idea of helping you to increase your chances of a profitable outcome. So, without further ado, we're going to take a look at chart number 1. We're going to get right into it. Let's take a look at the major asset classes. And I like to give you a big picture view of what's going on across the major asset classes and the ETFs tracking them. So this is a year-to-date performance chart since the start of 2021. And you'll notice that through the market close of July 2nd, commodities and real estate, global real estate, have been outperformers. USCI and REET leading the way. Higher inflation, of course, has pushed up these two asset classes. And at the bottom, you'll notice is Bitcoin Trust, GBTC, which started the year strong, but has since slid around 10% year to date. All of cryptos across the board, including Ethereum, Litecoin, Ripple, and the many others, are all in correction mode. They've been that way since May. But still, the year-over-year and multi-year performance numbers are still still up pretty big for cryptos. Here's a global look at the total stock market, broken down by single countries and regions. And the big takeaway here is just look at everything. It's up. All regions are positive year to date. And even commodity-heavy countries that were previously underperformers like Canada and Russia are now doing the best. And then you have other areas that were negative earlier in the year like Latin America and Brazil. They've now joined the party. Here's another way to look at stocks, a sector angle. So if we look at the industry groups in the S&P 500, and you can divide them into 11 different industry sectors, and there's ETFs tracking them. These are those tickers. XLE and XLF are the leaders. Those two areas tracking energy stocks and financials. Those are the hot performers, and they both got strong double-digit returns. And you'll see even some of those defensive industry sectors like utilities and consumer staples are still doing pretty good too. They're in positive territory. Of course, the one thing I will mention about a defensive sector like utilities, don't forget you're getting a pretty decent yield in addition to that performance return. So keep that in mind. Nevertheless, again, the trend in terms of stocks, not just sector-wise, but globally, is positive. And when you see the S&P 500 and NASDAQ breaking above all-time highs, and you see industry sectors, all sectors participating in those gains, that, again, is a healthy sign. The top leveraged ETFs for 2021 are focused on oil and gas, ticker symbol GUSH, energy, ERX, and financial stocks, FAS. Now, there's a longtime viewer by the name of Simon Collier, good friend of mine and of the show, wanted me to mention to everyone that the performance returns for leverage ETFs will greatly differ from the underlying indexes over longer time periods. And that's a great point, Simon. So let's just suppose, for example, a stock index goes up by 20% over a 2-year time frame, and you're holding on to a 2x leveraged ETF on that same index. Well, that 2x leverage ETF is not going to necessarily go up by 40% or 2 times the return of the index. It may only go up 30% or maybe 28% or some other figure that's not necessarily 2x of that index. And the reason is because over time, all leveraged ETFs have to deal with things like daily volatility, daily rebalancing, and that'll cause some variations in their return path. Also, leveraged ETFs are designed to meet a daily goal of 2x or 3x. They're not designed to meet a 2x or 3x monthly or yearly goal, so that's just something else to keep in mind. Here's a look at the Greed and Fear Index. Now, the single most important factor shaping market prices, do we remember what it is? It's public psychology. It's not PE ratios. It's not trading algorithms. It's not the Fed. I mean, those are all tertiary factors. The bottom line is it's public psychology that's the primary and driving factor. And when you have prices in any market that are hitting all-time highs like you have right now, typically what you'll see is a greed reading. Well, right now, we're seeing a neutral reading, which is probably more indicative of emotionally confused or perhaps indifferent public more than anything else. And this is a reading that comes from CNN. It's pretty good reading. It's got some muscle behind it, but sometimes we will see some odd outputs that don't necessarily match up with what we've experienced historically. So again, greed is typically associated with topping markets that are all-time highs. Right now we're at neutral, which is a little bit off. It's not exactly congruent with what's going on. So what does it mean? Well, again, I think it just means that the public is emotionally confused. There's probably a lot more indifference now than maybe in the past. But when we start getting into greedy reading, then of course it's time to obviously be a little bit more defensive and pay attention. Let's take a look at the next chart, which was posted on Twitter by one of our ETF battle judges. This is Eric Balchunas over at Bloomberg, and he posted this, which I thought was a interesting point and something that I'm going to share with you right now. The number one performing ETF during the first half of 2021, ticker symbol BDRY. This is a freight futures ETF that focuses on dry bulk shipping sector. And here's a chart that helps you appreciate the level of huge gains that this particular fund has enjoyed. You'll notice here that BDRY has outperformed both SPY and QQQ dramatically. And you're asking, well, what's behind this huge move? Well, a couple of things. First of all, global economies are reopening, pushing up demand for commodities from iron ore to industrial metals, to grains, to lumber. And most of the major commodities are transported by ships. Thus, demand for transportation has been increasing. Also, there's this secular trend of decarbonization, right? Clean energy, clean environment. And so that's having an impact on the shipping sector by limiting new shipping orders because the industry is waiting for new engine technologies to develop that are cleaner. And so that's further supporting the existing demand for shipping services. So there's a lot of factors going on here. Here's another look at BDRY's strategy. Again, it holds dry shipping futures contracts. This is a relatively new fund. It was launched in 2018, and it just crossed above 100 million in assets this year. Fund is managed by New York-based Breakwave Advisors. This type of fund, if you're wondering, well, where would this go inside my portfolio if I were to use it? Well, this is a non-core type of ETF. It goes in your non-core portfolio, as I teach in my online classes. You got your core. That's where the foundation of your portfolio is. Then your non-core, which is supportive of your core, and then your margin of safety, which does something completely different than your core and non-core. More on the margin of safety a little bit later, because that's an important element that often gets forgotten. And then let's just look at the key takeaways from today's episode. So we got commodities and real estate, top performing asset classes. Of course, those ETF tickers, USCI and REET, which track global real estate. And these are two major asset classes. So commodities, real estate, fixed income is another major asset class. That's been lagging. We didn't chart that one today. And then you've got stocks and then cash. So those are the really what I call the five biggies. And so in terms of other asset classes, cryptocurrencies are in correction mode. Longer term trajectory still remains up. And then we've got all 11 industry sectors within the S&P 500 positive year to date. That's healthy. That's what you want to see if you're a bull. You want to see broad participation by all industry groups. And then my public service announcement, always and only invest with an adequate cushion or margin of safety. Well, what do I mean by that? And when is the best time to implement your margin of safety inside your portfolio? Well, margin of safety is best implemented in a rising market, right? You don't want to do it when the market is correcting or when the market has already crashed. Think of it as insurance. You buy insurance before the storm, not during the storm, and certainly not after. And so having an adequate cushion or margin of safety is the same. You install the cushion when markets are sunny, as they are right now. And so this is something that I teach. It's fundamental. I also encourage all of our viewers to use the margin of safety worksheet that I created to help you calculate how much of your investment should be earmarked for safety. And you can get that by going to my site at etfguide.com. You can also hit the description section below. I've got a link in the investor toolkit, which contains the margin of safety worksheet. Again, that's in the investor toolkit. It's an ebook. You can get that margin of safety worksheet there, or you can also get it by enrolling in my flagship online course titled Build, Grow, and Protect Your Money, a step-by-step guide. This is a fundamental part of making sure that your investments are rooted strongly on a solid foundation. So having an adequate cushion is fundamental and important. And if you'd like to even a little deeper insight into your investment portfolio, maybe take a look at the fees of the investment portfolio, taxes, performance, diversification, risk. I'll be happy to analyze and grade your portfolio so you can get in touch with me. And I do this in all types of accounts, from Roth IRAs to traditional IRAs, 401k plans, 403b. And I do that at investment accounts held at any institution. And here's just a few examples of institutions where I've analyzed and graded portfolios from. So that just about does it for today's episode. I hope you've enjoyed it. We've talked about a lot of good things. And one final reminder, be sure to watch this week's episode of ETF Battles. It's going to be a quadruple header. It's going to be epic. Covered call ETFs. I know a lot of you are interested in income investing, so that's going to be something you will not want to miss. So again, thanks for joining me. Hit the like button if you've enjoyed today's video. Be sure to subscribe to ETF Guide TV. And I look forward to seeing you again. Be safe, be healthy, and we'll see you next time. I'm Ron DeLegge with ETF Guide TV. Thanks for watching.